Hello, investors. Happy Sunday. It is Colby the DGI Crab coming back at you with another video where I go over the 4 tiers. That is correct. This channel is focused on 60 high-quality dividend growth stocks with a long proven track record of increasing their dividends year over year, mostly wide moat, blue chip companies. And I'm only buying those stocks when they are undervalued, and I'm separating them off into those 4 separate tiers based on the age and time horizon of the investor, which I believe is the most important metric any dividend growth stock investor should take under consideration when investing for early retirement. Congress does not dictate my investing plan, and I don't think that it should dictate yours either. The name of the game is acquiring passive income when that passive income looks to be trading at a discount. And if you don't feel very confident in your ability to find stocks that are trading at a discount, then you're in the right place. I try to keep it nice and simple around here, take a lot of the guesswork out of it, and even if you're still not convinced that this is a nice, easy, sleep well at night way to invest, you can make it even simpler by going the ETF route. But so long as you're getting that sweet growing passive income, you are going to wind up with a very happy retirement, I must say. Now, I'm not a professional financial advisor, so don't take this as investment advice. Just take it as entertainment. You should do your own due diligence before investing any of your hard earned money. My personal strategy is as follows, you guys. It is 50% of new money every week goes into age appropriate ETFs for automatic diversification. I'm looking for individual single stocks that are yielding 30% or more above their 4 year average yield. And I will focus in primarily on my top 10 favorite stocks first, then go with stocks within my own age tier that look to be cheap, and then after that, I'll look in other tiers, and if there's a stock yielding 50% or more above the 4 year average yield, I'll reach over there and grab that too. It's just too good of a value at that point for me to pass up. And if there doesn't happen to be a viable stock in my age tier, I'll just add more to my ETFs. Pretty simple, straightforward strategy for me, and that is the way that I like to do things myself. There's plenty of things to worry about in this world without having to worry daily about your investments. Just, pick a strategy, go forward acquiring those passive dividends, and you will sleep well at night. Now, here are my top 10 favorite dividend growth stocks. I'm going to start out here before looking at the 4 separate tiers. I have my stocks separated by the valuation tab here, and this is showing me how far off the current day yield is from the 4 year average yield. In this example, Pepsi is yielding 33% higher than it typically has over the past 4 years, and thus it is clearly in my buy zone. Now, I like all of the stocks here that are at least 10% off the 4 year average. Union Pacific, Visa, great buying opportunity for a compounding play as opposed to a high yield play. McDonald's dipping under $300 certainly has my attention. Procter and Gamble, very nice play here. Just a steady stock with a 2.88% current day yield. Typically, this stock yields 2.43% on average over the last 4 years. So, really good plays here on these on the top 1, 2, 3, 4, 5 most undervalued stocks on the list here. I think these are great stocks no matter your age. But if we go into the tier breakdown, tier one, this is for those aged 18 to 30-year-old investors. Low starting yield, 1 to 2% typically. Rapid dividend growth rate, well above 10% is what we want out of this group, because if you're going to hold these and reinvest dividends for a long time, we want that dividend growth rate to be the thing that's really high, because that's what's going to make you the most money in dividends in the long term. The math just works that way, you guys. Now, United Health and Nike, still remain very undervalued. 4 year average yield on both continues to creep up just a little bit week in and week out. But Nike down here in the low 60s, in the low 70s, it's getting a little bit less appealing because it's just been down at about that point for over a year now. But when it gets even lower, down into the 60s, it starts to look even more appealing. Again, this is a group where we're probably going to be buying stuff that's yielding between 1 and 2% a lot of the time. United Health and Nike, you could get above 2.5%. So some pretty high yield for the 30 and younger crowd. But if you believe in the long-term prospects of United Health and Nike, which I do, might as well buy them while they're cheap because you're going to be holding a long time in this particular group. Tier 2, age 31 to 41-year-old investors. Starting yield gets a little bit higher in this group where we're looking more for 2 to 4% starting yield. We want high single-digit dividend growth rate out of this category, 7 to 9% year over year. This is the largest tier of the four with 19 stocks in it. And we've got the same four as last week here. Target, Hershey, McCormick, and American States Water all in the buy zone. I definitely like all of these. I can understand why you'd be a bit nervous with Target yielding, 5% or better. That's starting to, freak a lot of people out. I'm happy to buy it with the high starting yield. And McCormick and American States Water, very stable, consistent performers. They are the epitome of a tier 2 stock. If you're buying them right about here in the high 2% starting yield, these stocks are very consistently increasing their dividends by about 7 to 9% year over year. It's exactly what we want out of this category. Great buying opportunities for these two. Kind of unsung heroes. They don't get as much love or respect amongst the dividend investing community here on YouTube, in my opinion. And definitely a good time to add to your positions there. Tier 3, age 42 to 53-year-old investors, the category that I just graduated into earlier this month. Starting yield gets higher yet again in this category. Now we're looking more for 3 to 5% starting yield with about a mid-single-digit growth rate. We want to get around 4 to 6, maybe even 7% on a good year out of this group of stocks. Hormel is dropped down into the 21s. It started to do some recovering on Friday and just got a little bit up above 22. I still think Hormel's being really severely overpunished, but they did miss earnings in the previous earnings, so the market's going to punish you at least in the short term for that. But I'll still continue to add Hormel. I added a pretty decent chunk of it this past week as the most undervalued stock in my age category. And, I was looking at it and I thought, wow, yeah, that's a pretty nice high starting yield. I'm pretty happy to just start there and wait for the recovery. Pepsi, definitely been adding to that as well. And then Archer Daniels Midland had a slide this week and crept back into the buy zone. So we had definitely hit the pause button on buying Archer Daniels Midland around here, but there could be an opportunity here to get back into it here at this point. And American Tower as a REIT, this is one that I hold in my Roth IRA. I don't have American Tower in my brokerage. Just because of the way that REITs are taxed. But I think this is going to be a week where I need to come up with a little bit of cash to throw into my Roth. I have certainly not maxed that out yet this year. Sort of working towards that. I'm not sure if I'm going to prioritize maxing the Roth this year or not. The Roth is actually looking pretty healthy right now. And I might be prioritizing some other investing opportunities as opposed to maxing the Roth this year. We'll see. But American Tower here yielding 3.82%. It is perfectly in the buy zone right now. I think if American Tower gets any lower, just right around 177 even, I'm going to have to find some money to throw in there and add to my AMT position in the Roth. Tier 4, age 54 and older investors. This is the group where we need to really go after the starting yield now. At least 5% starting yield with hopefully still we're getting a 2, 3, maybe 4% dividend growth rate year over year. But we're definitely going after the yield in this category. Keep an eye on NNN REIT as it has now taken the #1 spot in the most undervalued category in this tier. We haven't gotten a lot of great bargains in this tier for a long time now. These are, okay values, but still nowhere near that 30% undervalued mark that I would like to see. In above a 6% starting yield starts to look attractive. And definitely keep your eye on One Oak, which I think, again, guys, One Oak might be the one stock out of all 60 of these where my 4-year average metric could be a little bit misleading just because of their acquisition and merger with MMP. So now if we go to the priorities for the week, for tier one, I would see, this is how I go for all of the different tiers. If I was 18 to 30, what am I doing first? Well, very first thing I'm doing is I'm putting half of my money into age appropriate ETFs. In my opinion, that's S&P 500, small cap value, maybe some dividend growth like VIG, and VYMI, some international exposure. I do 5% in my portfolio in VYMI just across the board. It's the only non-US stock holding that I have. Very happy with VYMI. That one's just been doing great this year. And then I'm going to look at the top 10 list where Pepsi, Waste Management, Visa all look reasonably attractive for a tier one investor right now. Within my own tier one values, I've got that United Health, I've got Nike as strong considerations, and then undervalued stocks in other tiers that are yielding at least 50% or more above the 4-year average. Well, you've got Target there in tier two, Hormel in tier three. Those are, and then on your watch list, I'd just keep an eye on Nordson. If it gets a little bit cheaper, it goes back into the buy zone. Automatic data processing has taken a little bit of a dip. It looks kind of appealing right now. I'd probably like to see it get maybe just a little bit cheaper than where it is right now. But if you wanted to jump in and grab it right now at 23% off the 4-year average, not a bad play there. Automatic data processing is an absolute machine of a dividend compounder. So getting a starting yield at 2.42%, not bad, because they very consistently are growing that dividend in the double digits year over year. That's a strong compounding play, young investors. Okay, for tier two, then, tier two, again, prioritizing the ETFs first. I'm going to prioritize dividend growth like VIG first in this category, and then follow up with some S&P 500 and small cap. Top 10 favorite stocks, Pepsi, of course. McDonald's and Union Pacific within my own tier look reasonably priced. Those could be pretty good ones to go after. In tier values, of course, Target, AWR, Hershey, McCormick, and the stocks in the other tiers yielding 50% or more above 4-year average. United Health and Nike down in tier 1, Hormel up in tier 3. Keep an eye on Texas Instruments, keep an eye on Starbucks. They're close but not quite as far as buy zone stocks for me. Plenty of options over here, though, without having to dip into Texas Instruments or Starbucks too early. For tier three, the ETFs, I definitely switch it up in tier three, and I've been doing this myself right now, and I've been enjoying it. I've been doing 25% allocation into SCHD since I entered into tier three, 15% into VYM, and then a little 5% into DHS. Little monthly income play. I call it the monthly version of VYM, the monthly paying version of VYM. Very similar in a lot of regards, but um, that's about the breakdown for me. Top 10, Pepsi, and then Procter and Gamble. I definitely have added to both of those within the last few days. Hormel, as I mentioned before, American Tower, Archer Daniels Midland, all looking good within my tier as buying opportunities. United Health, Nike, and Target are the ones I can go back down memory lane, reach back down into tier one and tier two and add some more of, which I believe I'm going to be doing with all three. Then Genuine Parts Company, still on the watch list for me in tier three. Hasn't hit the buy zone yet again, like it did a few months back when it dropped all the way down into the 115, 113 range. But definitely, if GPC gets too much lower, I'll be headed back over to add some to that. And then finally, for tier four, you've got a lot of ETFs and not a lot of stocks to review. Pepsi, not a bad ad if you can stomach adding some more growing related plays here at 54 and older. Still getting a decent starting yield near 4%. Again, One Oak might not be a bad stock to buy right now, yielding above 6%, but I'm probably not adding any of the single stocks. I'm going to be sticking primarily to my high yield ETF options, high yield bonds, preferred shares, covered call ETFs, plenty of excellent options, and I recommend